It is with great pleasure I introduce Mr. Stephen Pagliuca for our first iconic speaker of the day. Mr. Pagliuca is an MD at Bain Capital, where he focuses on the TMT industry. He is also a longtime Bostonian and a co-owner of the Boston Celtics. As a former partner at Bain & Company, he focused on really developing the turnaround practice. Bain Capital is a private investment shop focused on private equity and venture capital with over $80 billion in assets. And please join me in welcoming Mr. Pagliuca to the stage.
Can you guys hear me? Well, good morning. You look very good for a Saturday morning in college, much better than I looked on those Saturday mornings back at Duke University. Appreciate you coming out. You know, my background, just to start before we get into the presentation, is my grandfather was a shoemaker in New York. Actually not a shoemaker, worked on a shoe factory floor. And my parents, my father was first generation, always wanted me to grow up and get an accounting degree because they thought the Depression was right around the corner. You know, they had lived through the Depression and said that the only people that were employed during the Depression were accountants and some lawyers. And so they said I would always have a job if I studied accounting. You know, so I went to Duke University. I did major in accounting at the behest of my grandfather and my father. And what I realized later was that to get a CPA, you had to work for 3 years. So I was signing up for, you know, kind of a 7-year program, a little bit like you guys are in a co-op. And I think the co-op thing is just a great idea because although I'm not an accountant now, it really gave me a great background of business experience, you know, a lot of mentors and really learned about business. And I think you have a real advantage at Northeastern because you're doing that, you know, right while you're in college. So I think it's a very, very valuable experience. So let me talk a little bit about, first about Bain Capital, then we'll get into what's happening in the global economy and finish off with you're probably pretty curious of where private equity is going. We can talk about that in the Q&A as well. You know, why don't I start in and we'll get this up and running. First, a little bit about Bain Capital. Really, when Bain Capital was started back in 1984, I had joined Bain & Company. And the way I joined Bain & Company is I was actually at Harvard trying to get a degree in economics. I did the accounting and then I was going to be an economics professor. But I really couldn't afford the degree. So I applied for summer jobs and I got a summer job at Bain & Company, the consulting firm. And they really opened my eyes to kind of transformational capabilities in terms of growing and building businesses. And in the recruiting process, and they convinced me to kind of join them instead of get the doctorate degree. And I thought I'd go back. I've been gone 30 years now. I haven't gotten the doctorate degree, but there's always time. So they convinced me to join that summer and just get an MBA. So I got the MBA and I joined Bain & Company. In the time of recruiting, they talked about the fact that they thought the skills in working with large companies could really be relevant to doing venture capital. At the time it was called venture capital. There was no such word as private equity. That's a fancy word describing kind of a whole host of things right now. But really back then there was just venture capital. It was mainly in the more northeast, the west, and a United States phenomenon. So they had mentioned that, and I thought, okay, maybe that'll happen or not happen. But in 1984, they actually said, let's start an investment arm. And that investment arm was called Bain Capital. And it was very difficult in those days because they were all consultants, and we were consultants. And many investors, we went to investors, took about a year and a half, and no institution signed up to invest into the fund. I think we had one, a Bessemer Trust, put $5 million in. But the first fund was $35 million, targeted to kind of buy companies, invest in companies, and grow companies. But most of the money just came from friends of the Bain Capital partners and all over the world, individuals, and one institution because they said, gee, I don't know if this will work. You know, most people who had been in that business were from investment banks and had financial backgrounds, and we really had kind of operating and consulting backgrounds. But it turns out that core principle of applying those skills in terms of building and growing companies really worked. Secondly, of a core principle is all the money in the fund, the most of it came from Bain & Company partners and Bain Capital partners. So it was a philosophy of kind of eat your own cooking. And those principles have really kind of stayed with us today. You know, we are still today, 30 years later, starting from that $36 million fund. And one of the first investments, for example, was Staples. And at the time, Staples was a concept that Tom Stenberg had, and he came to our offices, and we did a study and said, gee, I think it'll be a lot easier for entrepreneurs and business people to buy office supplies and buy equipment to set up offices and business in one large place. In those days, back in the early 80s, you had to go to stationery stores and separate stores to buy computers and separate stores to buy copy machines and all those kinds of things. And Tom Stenberg had the idea to put that all in one place. And you know, now we take it for granted, but back in that day, that was a revolutionary idea. I remember sitting around the office. I think we put $2 million into the company, and we were sitting around the office saying, well, I don't know if anybody's going to walk into a store the size of a football field to buy stationery, to buy copy equipment. But we thought it was a good idea. It would be low cost for the consumer. It would be one-stop shop. And we said, if we put $2 million in, we can always get $1 million back if it fails because we can always sell the paper. And today it's a $10 billion multinational corporation, and it dominates the office supply scene. So our really kind of fundamental principles has never left us is, number one, we really wanted to go in and help build and grow great businesses and help businesses with resources to do that. So we have, today we have 1,000 people, and we have 70 people just dedicated to helping those businesses do strategic plans and to grow and to figure out where to go on a multinational basis, how to do acquisitions, all those kind of value-added services. The second piece of the puzzle was really a partnership culture. So, and what that means is we work with our companies. You know, they don't work for us. We work with them as if we were consultants. It means that we treat everybody fairly inside of Bain Capital, and the number one concept is to be aligned with our limited partners who invest their funds in our money, and therefore we're the largest investor in each of our own funds. So every time we do a fund, everyone from Bain Capital invests, and we make sure we're at least the top, or sometimes with these huge funds, the number two investor in those funds. And then thirdly, we've always had a great relationship with the community. Way back in the 80s, Mitt Romney and some of our partners helped start City Year, and we've been involved with them for ever since the start. And I think this year we're sponsoring their 25th anniversary throughout the country. And we formed our own organization a long time ago called Bain Capital Children's Charities, and also something called Bain Capital Community Partnership, which really works with a lot of charities in town here and throughout the world to use some of these same talents and skills to help us be good citizens of the community. As I said, we've now built this up to about $70 billion in assets. And that same concept that I talked about in terms of helping private equity companies grow and venture capital companies grow, we've applied that same concept to other businesses. So our whole business philosophy is to do better analysis on competitors, costs, and strategy, and then make good investment selections, and in many cases, directly help those companies in the businesses, such as a hedge fund. We're also influential in driving those companies together on a strategic basis. Most of our funds have been in the top quartile for many, many years, so this concept has worked well. Now I'd like to talk about kind of what's happened in the last 30 years. I started out at Bain in '82, Bain Capital in '89, and we've seen dramatic changes over the last 30 years. And this is a really interesting slide. You probably haven't seen data from the 1700s. I don't know how accurate it is, but we pieced it together from many, many sources. But the point is, in the 1700s, half the global economy, half the GDP of the world was China and India. They had the lead in trade and spices, in paper, and they were basically the leaders of the global economy. The Industrial Revolution came along in 1950 and kind of upset the entire apple cart because their systems did not adopt into that revolution, and the United States and Europe really took a huge, in our lifetimes, has taken a huge lead in the global economy. When I started out in '82, China was really not even a factor in the global economy. It was probably 5% of the United States GDP was in China. what we've seen now is kind of a revolution with technology, with the change in systems, with all these countries adopting more of a managed capitalistic system. You've seen China and India make a huge comeback. And if you look out in 2050, the world is going to be back like it was in 1700, with them taking 40 to 45% of the GDP by the 21st century. You will have them being half the world GDP again, as they were back in 1700. And I think that's a change that's fundamental, and that's been driving the global economy more than anything else. If you look at what's happened in terms of trade just in the last 50 years, this chart shows that of the $80 trillion in global trade, 56% of it is from global trade. Back 50 years ago, that number was 25%. And that has really, I think, caused an explosion of private equity, capital being invested all over the world, the transportability of capital. And that's kind of affected our lives at Bain Capital as we've expanded and have a global presence now. So that's a fundamental thing of our lifetimes, and that'll continue on as you go out and get jobs. You'll see how interdependent all the nations are, which makes it very, very complicated. If we take a spin around, what's happening today, as some of you have been entering the job market, I've tried to kind of, this could be a 3-hour lecture, but I'm going to kind of drive through each of the major economies. The United States obviously had the huge crisis in 2008. I think our government did a better job reacting to that crisis, probably better than anybody in the world. And they kind of rapidly came in and stabilized the banks, put in a stimulus system. I think averted what could have been, it was a terrible crisis, but could have averted maybe that depression we talked about at the beginning. I think they averted that by the actions that they took. They didn't do everything correct, but I think by and large, they did the right thing to stabilize the markets and to get the economy going again. People expected a faster turnaround, but I think the problems of the leverage and things that had happened in the previous 20 years were not going to be reversed in 1 year, and they did a good job. And now we're seeing some of the results of that right now. We're not out of the woods yet, but we're seeing kind of slower and steady growth. If we move to Europe, Europe didn't react as quickly, and they've always lagged the United States a little bit in terms of actions, and it's not a federal system, which they have painfully realized right now. They had a monetary union without a federal union, so it was really harder to address the crisis. But I think they now have done that as well, and you're seeing the banks in Europe getting more stabilized. And there's more opportunity for private equity as well, because the banks have kind of extended all their loans. They didn't really address the problems. They're starting to address them now. So we're seeing some more companies for sale and some more companies that are available that need capital. China, we talked about China. China has gone on a massive drive to improve their standard of living, and that's involved introducing capitalist principles and building companies, and they've done that at an incredible pace. They've slowed down recently, but slowing down for them means growing at 8% a year versus the developed economies at 2% a year. So they are really forced to do this because they have the center of the country is still very, very low GDP per capita. The poor people are there, and they're all moving to the coast where the technology is and where the manufacturing is, and they expect a higher standard of living. So the government's #1 priority there is to grow that economy and try to lift up that standard of living. Otherwise, they won't be in power. So they're very, very focused on that. And 2 years ago, they started to undergo a change in leadership, which is a very complex process in China. We have elections, and we've been doing that for hundreds of years, and we should be thankful that that has been one of the few countries that has such a tradition that we can have one system come in power, one system come out of power, and it's kind of a natural thing in America. The Chinese transitions are really behind closed doors, and they happen every 10 years. And it's a very complicated and complex process. And I think they've gotten through that smoothly, and they've rededicated themselves to growing the economy. So people saw some risk in that, but that's less of a risk today. Japan is undergoing, following many of the European and U.S. Economic policies, major kind of reflation, and that's had a positive short-term effect. We've seen some good things happen in Japan ourselves and have made several investments, but the jury's still out on what's going to happen with that experiment. Will that lead to inflation from the deflation that they've had in the past? India has a lot of strengths. They've really grown the economy just like China has. They're kind of stumbling today. They've had a major currency devaluation, and they really haven't developed transparency and government systems, to be on top of business and regulate it in the appropriate way. So right now, I'd say India is a question mark, and most of the investors I talk to are very wary of India, and we've seen some issues ourselves in India where they're not having the type of transparency and the type of kind of rule of law to make it comfortable to make great foreign investments in there. You're taking a lot of risk because the court process is cumbersome. There still is a lot of bribery and fraud in the business world and the governmental world. I think they're trying to address that, but I think that's their number one challenge if they want to continue to attract foreign investment in India. Latin America, you've seen strong growth, mainly driven by Brazil. They have recently stumbled as well, but I think long term, with their resource base and with the people that they have, they're going to continue to grow down there. And the Middle East is booming again. I've just come back from another trip in the Middle East a month ago, and the Middle East has realized that they have got to develop a middle class, so they're making major investments throughout their economy to diversify away from oil. They can do that because the oil prices are over $100 a barrel, and they're very small countries, so they have enormous amounts of capital, and that's causing a positive economic progress in the region. And I think Dubai has over 7 million tourists coming into it today, and they've built a major city on the coast there, and there are just amazing things happening. And I think they realize that they again have to lift their people up as well, otherwise they will not be a great place to be. Some of the issues that we face out there that I think really have to come to the forefront are that most of the countries, we got in trouble because the consumer and the governments at the same time were over-leveraged. The United States, it was the consumer and the government. In most of these other countries, it's mainly the government that's over-leveraged. And when you think about it, when I got out of business school, when I graduated business school in 1982, the U.S. national debt, the entire national debt that we owed, that we'd built up over the previous 240 years or so, was $1 trillion. And in fact, I think when we crossed that level in 83 or 84, there was a big outcry. Today, I guess our contribution for the last 30 years has been that the national debt is $14 trillion. And I think some of that is to be expected, but 14 times in the last 30 years is an awful lot. And in the crisis in 2010-11, our deficits per year were running $1 trillion a year. So it's amazing we added in 1 year what took 200 years to do. I think that's going to be one of the major issues you'll face and we'll face in the next 20 years on how we get the Congress to have a plan that gets those lines to come together. We cannot constantly outspend the revenues that we take in. It's getting better. It's down to kind of $500 billion right now. But at some point, and it doesn't have to be tomorrow, but at some point I believe it'll really affect our economy and the business of our economy if we don't get that under control. We don't have to do it this year, but if we had a 7-year to 10-year plan, which to me seems very doable, that would be very good for business and good for the country. So it's something that we've got to get the Congress to address. This is a chart that just shows the percent of debt to GDP. Japan's a little distorted since they self-fund, but they have borrowings of the government 2.5 times their GDP. The United States is about 100% of the GDP in terms of the national debt, and hopefully we can start to bring that number down over time. This is an interesting chart that talks about the fact that if you look at all the other recessions we've had, 2008 is the toughest one that certainly in my business lifetime we've lived through. We had the crash of '87, we had the tech bubble crash, but this one was very severe. In almost all the other recessions, we came out of it in 12 to 18 months, and we had a very rapid trajectory upward. That was caused by the fact that in recessions, manufacturing companies, kind of closed down capacity, furloughed workers, really manufactured less and had less employment. As in the last 30 years, we've moved to more of a service economy and lost manufacturing to lower cost countries. We've now come in a situation when the recession like this has hit. It's taken us a long time to get employment back because we don't have the quick snap back on manufacturing. We actually have been helped in recent months and years by this shale gas boom. And that's really driving incredible low-cost productivity in the middle of the country and a lot of direct exploration. And it's lowered our manufacturing costs, so we have gotten a little bump. But if you look at that chart, it's concerning because it's taking a long time to get back to, quote, full employment. And the only way we're going to get back to full employment is not through manufacturing, because we've lost a lot of those jobs and they won't come back because of the wage rates. In China, the wage rate of manufacturing has gone from something like $1.32 to maybe $1.80 today. In the United States, it's $36. So there's a huge imbalance in terms of what those rates are. So I don't think we're going to attract a lot of those jobs back. But what we can do is really expand in services, the knowledge economy, and all the things that are happening in medical, Silicon Valley, and those places. And that's very, very important, I think, for us to get back to full employment. But it's going to take a while. Sequestration, has not been helpful to that process, because essentially sequestration has squeezed down the discretionary budget. That discretionary budget is used for things like education programs. It's used for things like investments in the sciences. So that's been a very negative dynamic. The reaction to balancing the budget has been sequestration. Again, my pitch is what we need to do for our country is to really get this thing in balance over a 7 to 10 year period and do it in a thoughtful way where we actually keep the discretionary part and we're investing in R&D, we're investing in education. When you do that, that's going to increase our knowledge economy, increase our jobs. But unfortunately, the sequestration has put that in the wrong direction. It's cutting all the things that actually could cause growth and help growth. But hopefully the Congress will, again, address that in the future. Now let me talk a bit about private equity and what this all means for private equity. First of all, you're probably seeing a lot of speakers who are in different disciplines, and private equity is a big word. What does it mean? Well, private equity means venture capital. And Bain Capital, we have a very robust venture capital business where we invest in founders of businesses and try to build and grow those. They're early or middle stage type businesses. We made an investment, for example, in a company called Kiva Systems, which was a robotics company to automate warehousing. And we put some of the initial investment into a company with people who had a great idea. And that company was just sold to Amazon.com for $700 million. It was a huge success. Great thing for Boston, big increase in employment here. And now those robotics are being used in a lot of state-of-the-art warehouses. So venture capital is a very interesting area and robust here in Boston. Private equity also provides growth capital for mid-stage companies, and we do that as well at Bain Capital. Private equity also it provides a platform for growth when you buy a company and you want to expand it by buying other companies. And finally, private equity is really useful in a term we call renewal, where many industries, and maybe Dell would be the example that you mentioned here earlier today. Dell was undergoing a big strategic transformation as the PC business became more commoditized. So that company was taken private so you can make a long-term strategy, which is difficult to do in the public markets as they tried to cut back from PCs and go into services. That hurts your quarterly and monthly earnings. The markets like to see much more stability in that. So hard to operate as a public company if you're trying to kind of change the business direction and renew it and have a different kind of focus where you're going to have to invest to reduce the earnings in the short term to make the earnings in the long term better. So private equity encompasses that whole range, and I think it's a very exciting field, and I think it's going to be here to stay for a long time, and I'll talk about that a little more as we go forward. Why do I like private equity? What are the advantages of private equity? Well, the first is that we are really active in helping shape and grow these companies. We're very involved investor owners, and it's a great model because everybody is aligned. The management has equity. Our investors, our investor base has equity. We have equity in the businesses, so we're all aligned to make the same thing happen. We've built up a huge amount of expertise and talent to apply to these companies, and we have a lot of capital that can take a long-term perspective. So I found the business really, really enjoyable because we've been able to go into companies and grow and build some great companies like Ameritrade. We're involved in that. We were involved in Staples and hundreds of situations where we've really helped improve and build companies in partnership with management teams and getting capital from pension funds and university systems. In terms of the market today, you can see that the amount of basically deal volume really shot up in 2005, 6, and 7, probably to an unsustainable level, almost a bubble-like level, given the cheap availability of debt and how well the world economy was doing. You saw a massive slowdown in deal activity post the 2008 crash and restructuring. But what's interesting is in coming out of 2008, in fact, the private equity companies did very, very well versus what people predicted. You use a little more leverage in private equity companies because you're borrowing money to buy these companies, but the entire industry structured that debt so it was pretty patient debt. There were enough cash flows there to weather a storm, even a storm like the 2008 recession. So actually default rates have been very low in terms of that paper, and those portfolios have bounced back, and you can see commensurate with that, actually deal volume starting to go back up. The returns on any kind of way you cut it, 10 years, 5 years, 20 years, have really outperformed the S&P of the public markets. So even in that crisis period, we outperformed those kinds of markets. So the result has been that fundraising is kind of back to normalized levels. I think a very sustainable and normalized level, and the business is starting to grow again. In terms of what our strategy is and what I think is a good one for the industry is we basically play up and down the capital structure. So we do everything from venture to private equity to debt funds, and understand the entire role of the capital structure. We've also globalized the business. So rather than being just in Boston now, we're on the West Coast, the East Coast, the Midwest. We have offices in Shanghai, Mumbai, Tokyo, Munich, London, and major activities throughout the globe, which allows us to kind of bring this value-added consulting approach globally and understand every piece of the capital structure. And finally, we've really developed deep vertical market expertise. I think if you think about the first 10 or 15 years of Bain Capital, we had great strategic generalist skills. In the last 10 years, we've really developed TMT, healthcare, industrial, consumer retail platforms within our firm where we have experts in every area, and those experts can rapidly go out and assess transactions and also be of great help to management teams because they have a detailed understanding of the industry and how it works and who can gain share and who can lose share and how to build a great company in that industry. So that's a very exciting dynamic that's happened in the last 10 years, which increases the ability of private equity firms to actually help build and grow these companies. What's interesting is if you look at our entire portfolio, we looked at it and said, how much have we grown revenues versus the S&P or versus U.S. GDP over our entire 30-year history. And we just crossed 30 years this year. And it turns out that if you take our entire portfolio, every company, I think it's 350 companies we've invested into, they have grown at about 17% on average, which is 2.5 times the GDP and 2.5 times the S&P. So this is a testament to the fact that I think top private equity firms really do grow companies. It's a misnomer that you can really create great returns for investors by going in and just cutting costs or cutting pensions. I think that may have happened 25 or 30 years ago where companies had gold-plated plans. Companies are very competitive right now. And really the only way to be successful as an investor is to go into a company and have it achieve growth, higher than the market growth, and then leave it in a place where when you're going to take it public or when you're going to sell it to a major corporation, it has to have a plan that's going to grow for the next 5 years. So you have to take a very long-term, high investment approach, and it's a misnomer from I think, the numerous elections and popular press that what private equity does is it comes in and just cuts costs. It couldn't be further from the truth. If you look at portfolio company after portfolio company, in this day and age, the only way you can be successful for investors is to grow and build great companies with great strategic positions that have growth left in them. And this slide shows that we've been doing that for 30 years, and the only way to be successful, certainly in a world now where the global growth is slower, is to find companies that you can build and get those kind of growth rates where you can take them public at good multiples and where other buyers will want to invest in it in what is a very exciting opportunity. So I think if you take anything out of this talk, it would be that wherever you go, what the world is demanding is very strong, well-placed strategic companies that can grow and build upon their technologies or whatever they do and be the best in the world at doing that. And we're really looking for those kinds of companies that we think we can have that kind of transformational effect on, and are very excited about doing that in the future. So if I take it back to an industry level, you know, why I think the private equity model is a good one and why it will sustain and as it matures and be a great business in the next 20 or 30 years is because it really has, the great firms really have developed a value-added focus. They have global reach. They have differential diligence and sourcing capabilities and this industry expertise that I talked about. And we're squarely trying to lead the trend on that. And that's paying off in growing companies, in exciting companies, and ones that, you know, give great returns for investors. You know, we bought a company, a forced divestiture from a bank, from the Royal Bank of Scotland in England, that was the largest credit card processor, or one of the top two, at a 48% market share in London, in the whole UK. And for example, we've invested now, I think, around $500 million in building new systems that will be lower cost, better for the merchants, better for the consumers. And we're about to turn that system, you know, online right now, and have turned that company, which had underinvested into those kinds of systems, into a low-cost, high-quality provider, grown that company, and we're going to see great, I think, progress, and have a much better company than when we bought that company. So again, private equity really looks for opportunities to kind of invest and grow businesses. We're immune to the quarterly and daily earnings blip, and that's why I'm so excited about its future and what it can do. So the bottom line, if you're really talking about private equity, is that I think the global economy faces a lot of challenges. We're seeming to get over some of those challenges. I think we need to get over the debt one, you know, faster than we're doing that, but we are starting to see progress on that. We are really a great solution to invest and grow businesses on a global basis, and I think we've had a real impact in beyond the United States into Europe, into China, and starting now into Latin America as well. I think it's a very exciting area. I think you're going to see growth in it in the next 20 to 30 years. I think it's really kind of come of age, and we're excited at Bain Capital to continue to participate in this industry. And I'd recommend, you know, all of you looking at the industry and seeing what opportunities are there. So thank you very much, and I'll open it up to questions.
Hi. So my question's about the national debt. You sort of touched on this a little bit, but it's not a new problem. What would you say are the sort of primary concerns going forward, and what's the time frame for them to settle in? Because you said a 7 to 10 year plan is possible. So what's kind of the amount of time you can go without doing anything?
Well, I think that's a great question. If I knew the exact answer to that question, I'd probably be on a boat in the Mediterranean at this point in time. But really, if you step back from it, at the height of the crisis, we were probably spending, I think, 25 or 26% of the GDP was government expenditures. They were spending $4 trillion. At the time, we were taking in $2.7 or $2.8 trillion, so we had a deficit of $1.2 trillion. Now that's come down with sequestration and the economy doing better to about $500 billion. I think what the Congress has to do is say, if we're going to balance the budget, the last time the budget was balanced was the Clinton administration, which I believe we collected around 21% or 20.6% of the GDP in federal taxes, and we spent 20.3 or so. So we had a balance for 2 or 3 years that way. So what the Congress has to do is, and the people have to do is say, okay, let's step back. How much do we want federal taxation to be? And in the history of time, that number's been as high as, you know, in the crisis, maybe it's 25, 26% of the GDP. It's been as low as 16% of the GDP. But somewhere in there is a number that we have to rally around. So let's pick an arbitrary number. It's say 21%, 22%. We then have to manage expenditures to be at that same percentage level. And right now they're running, I think, at 24 or so. So if you think about a graph, you'd have a line at 4% today expenditures and 21% tax collections, and maybe 10 years out you make those lines meet. So if you took expenses down by 0.3% per year for 10 years or so, and you took taxes up 0.2% for 10 years or so, you would get those lines in the balance. That seems pretty simple from a mathematical standpoint. It is hard from a political standpoint because the way our system is been constructed is that anybody who wants to raise taxes doesn't get elected, and anybody who wants to increase spending doesn't get elected. So it's led to kind of a stalemate. So nothing's happening because no one wants to take the first step and make those kind of tough decisions. So hopefully, we're going to get a Congress and get more of a national will to do that. The problem is politically with our system, it's been very tough to do. And in terms of when you have a real problem, that's a great question. It's hard to say. The scary thing would be to think about is we have 14 and a half, 15 trillion of national debt right now. And interest rates on that debt are at an all-time low. Interest rates are, the T-bill yields are at an all-time low. So I think the total interest expenditures for the U.S. is something like $450 billion. Even with that all-time low interest rates, because the average in the last 10 or 15 years has been somewhere around the 5% mark. So even with it being less than half of that, interest expenditures are still the third largest expenditure in the government. The first is defense, and defense and healthcare are neck and neck, and then interest has moved into third right now. If interest rates go back to 5%, let's say people will not lend to the United States, they don't like the level of debt, so they come up to 5%. That would double those expenditures to be $700, $800 billion per year. They'd now be the largest expense of a budget. We're only taking in, something on the order of $3 trillion a year. So a third of the budget would be interest expense, which a lot of that is paying back things that are not productive to the economy. So that's the math problem. The political problem is to get people to sit down and kind of come to the middle and solve that problem. I think if you did have a 10-year plan, even a 10-year plan to do that, you would get more stability in business, there'd be more predictability, and we'd probably get there faster because the economy would grow faster because people would say, okay, we've addressed this problem, we're going to have stability, we're not going to see major spikes in interest rates because we're growing the debt too quickly. So I think there'd be a huge amount of positive benefit, but it is a very complex problem to get the political will and people to come together to compromise for that in the middle. And the good news for America is we have a huge, what's really helped us a lot is that we have had a huge oil and gas boom where I think they're predicting by 2020 we'll be almost energy self-sufficient. We've had a good conservation movement. And that's been, I think helping our economy and helping us not have a crisis. I think that won't last forever, so I think you got to get ahead of that. And if you think about the situation in Greece, one day it was booming. I was there for the Olympics. It was booming. People were sipping ouzo. People were celebrating. And they kept building this debt up. And at some point, I don't know how, when, at some point it reaches a tipping point. And people say it's just too much. Now, the United States, we don't have that situation since we're such a huge economy. People have confidence that we are going to come out of this. So it's not a crisis. It's not a problem even of this year, but it's going to be a problem, I think, in the next 10 years at some point. It's got to be addressed. I can't tell you when. And luckily, our economy is very, very strong, so people have confidence in it. But if people start to lose that confidence, that's when you have a big issue.
I know you guys have been rather successful on the whole, but nobody bats 1,000. Can you talk at all about some situations where your investments haven't necessarily worked out so great?
That's a great question. I think if we look back in general from Bain Capital in the industry, we've actually studied the last 1,000 transactions that have been done. And there are probably two insights that we've had from that. The first is that when you're paying high multiples for high growth companies, and the plan is to continue to grow them, and when I say high growth companies, I mean companies that are growing, that you think you can grow 12, 13, 14%. So an example for us was Dunkin' Donuts. We paid a high multiple to buy what was then a division of Diageo, a division of a spirits company. And we felt that focusing on Dunkin' Donuts itself, we had a rollout plan to roll across the United States. It could do as well everywhere else, or near as well as it has done in the Boston and New England area. And we paid a high multiple to try to achieve that growth, and we thought we could open up thousands of more stores. We were very successful with that investment. It's a great public company today, and they did open up all those stores. So we did pay a high multiple, and we did get high growth. What we've seen in industry data, and for our own data as well, is if you're not really sure about that growth, if you don't have a really specific plan where you think it's replicable, let's say you buy a software company and you're planning to pay a big multiple to grow at 20% per year. If the market's not there, or if you don't have a really solid view that that's going to happen, then when you go to take the company public or sell it, you get less of a multiple. So if you paid 20 and you sell it for 12, it's a bad investment. So the first lesson I think from the 1,000 transaction was you need to really match the multiple to the growth rate that you think you can achieve, and you've got to really test that growth rate. The second is in an era with very inexpensive debt and banks willing to give you a lot of debt, you can fall into a trap of doing a transaction because you only have to put 9 or 10% equity into the transaction. And if you improve that company, let's say you buy a company for $100 million and it's making $10 million, so you paid 10 times for that company, but you're able to finance it by getting $90 million of debt. So you only have to move the earnings a little bit of the company to get a good return because you have so little equity. I think what I call the siren song of inexpensive debt has been a problem where people take on a lot of debt and then you have an economic downturn. Maybe we won't see another one like 2008, but 2008 was certainly a huge one. And when you have an economic downturn, it puts the company under stress. So I think the two things you learn on what makes a good deal a bad deal is one, don't overpay for growth, pay the appropriate level for the growth that you're going to get, and two, don't count on leverage as the major tool to increase the value of the company. Put an appropriate amount of leverage on the company so it can withstand downturns, and you can make a great return, on the investment, without having to have a 9-to-1, leverage ratio.
So one thing I found pretty interesting is that every speaker that we had seems to be very optimistic about emerging markets. You talk a lot about the growth, but when you look in some of the public equity markets right now, say Brazil, Russia, China. So my question is, how do you think a private equity firm would play in a market like this? And the second part of the question is, how do you see tapering affecting emerging markets?
Well, it's interesting. All these markets go in cycles, and there's shifting of investments and values, market to market. At Bain Capital, we try to take a very fundamental approach. So I think long-term emerging markets are a good investment, but the question is how much do you pay, and what will the growth be in those companies in those markets? So, for example, what many people have found is the fact that the United States and Europe have such more stable political systems and more transparency, that actually in slower growth GDP markets, you can actually do better with investments because of the stability and the rules and kind of the way that the whole system works. And you can buy companies and gain share or come up with new technologies and grow those companies and do exports as well. It's fantastic that you have a tailwind in places like China or Brazil with the kind of growth rates. But the problem is there's not as developed a market, and people are paying a lot of money. So if you invest in China and pay 50 times earnings for a company, you have to do really, really well. You have to, as I said before, you have to sustain those growth rates. And what you've seen recently is the growth rates come down a little bit in China, come down a little bit in Brazil. They have some of the same kind of deficit problems and currency problems. So basically, the kind of allure of just paying a lot for growth per se, has been burst. And so the valuations have come back to more reasonable levels. What that means is it's probably a reasonable time to start looking at those things on a fundamental, basis. In terms of tapering, that's a great question, and that's a huge issue. To stave off this financial crisis, we basically issued a lot of money and made cheap credit throughout the world. And so the world is facing the tapering issue. And the bet was made that increasing, having these loans out there, and have the government support business and jobs and saving these things was the right trade-off to make. There's always a cost for that trade-off, and the cost for that trade-off is you've got to pay it back at some point. And the tricky thing on tapering is you want to pay it back slow enough so it doesn't change the psychology, it doesn't change the fundamental view that we are, progressing the economy forward. So as I said before, I probably wouldn't balance the budget overnight. It would be a bad thing to balance the budget overnight because it could cause too much of a tax shock and too much of a debt shock to the markets. So tapering is going to be a very artful process where it's done slowly, over a multi-year period. It took us 15 years to build up the debt levels we had with subprime mortgages, both on the consumer and the government. It took us 15, 20 years to get in that situation. So it's going to take us, a while to taper out of that situation. And so far, they're handling it, pretty well. The markets, have not reacted negatively, which would mean if you buy into that, you'd say we'll probably have a period of reasonably low interest rates for the next, 5 to 7 years, because if interest rates go up, it has that kind of ratcheting effect on the interest expense and on the deficit. So tapering plus low interest rates for a sustained period of time, hopefully will be successful to get us on the right path.
One more question. So thank you for your presentation. You talked a little bit about the macro view of the Middle East, Europe, and the U.S. and Latin America. What are your views on the outlook of private equity in sub-Saharan Africa? What do you think the risks that are associated there that are kind of causing investors to be a little bit hesitant about moving in there too quickly? And what do you think are the industries that are going to become popular in the next 5 to 10 years?
Well, I need a real crystal ball for that one. I think that sub-Saharan Africa is an interesting place, just as China was and India was and is. The issue is really one of back on the rule of law, transparency, political stability, and I'd also add for those areas infrastructure. If you really, I've been in those areas and they're making amazing strides in education and there is more stability, but when you think about the infrastructure that has been built up in the rest of the world, it is just not there in those areas. If you go outside major cities in African and sub-Saharan nations, many of them quickly turn into dirt roads. And you'll see, you'll drive down there and you'll see a truck tipped over that's on the side of the road, and you'll pass, one after another of these because they haven't moved them out of there. It's very difficult to move them out of there, and you still see people walking, carrying things. So we take for granted in Europe and the United States that there are paved highways from end to end of the country. There are railway systems from end to end in giant pieces of territory. You just don't have that in those areas. It will happen someday. But the combination of lack of infrastructure plus changing governments and civil rights and issues of social stability, make it a riskier place to do business. So it is a little more of the Wild West, and I think to invest in those areas, you have to probably find great partners, and have a real understanding, who have a real understanding of the country and the politics and the stability of how you can operate there. And then I think you have to be very selective, and I think you probably have to deploy capital on a diversified basis because you have a real chance if you put too much capital in any one area, if you put in energy and they can nationalize the energy companies, you'll be fighting to get that capital back. So I think you need kind of a cautious, diversified, thoughtful approach to that. In terms of industries of the future, right now sitting here, I think we've only scratched the surface of the technology boom. Technology has kind of really helped increase the fact that we have 56% of world 80 trillion GDP is in trade. That's because of technology. We take it for granted right now that you can, hit your email and cell phone and speak to somebody in India instantaneously, and they can speak back to you, and China can do the same as well. It's revolutionized logistics. It's revolutionized the way to do business on a global basis. The world is becoming, as they say, a very much smaller place. If you think about it, even when hopefully I'm not that old, but when I got into the business, we were still on the back end of if we wanted to do something in Japan with the Tokyo office of Bain, we'd get a telex. You hear clattering, and you get these telexes coming in, and then faxes, with curled paper, coming in. It's just amazing, today, even in our operations at Bain Capital, I could sit here this morning and, leave a message for someone in Tokyo or India, and they'd get me an answer back, in 20 minutes on some business issue or problem. So it really has increased the ability to do global commerce. So I think technology, global commerce, and then a huge issue in the world is going to be healthcare. The United States, is a leader in healthcare. You're seeing here in this Cambridge area, biotech boom. We're building kind of the Silicon Valley of healthcare. I'd also, in this area, like to bring back the Silicon Valley that we had here that went to California, and I think that's starting to happen. And I've been active in pressing, universities and governments here to build these innovation districts, because the way back to full employment, I think, are these clusters in America where you build kind of an ecosystem that is the best in the world at hardware, software, medical advances, biotechnology, mathematics, aerospace, those kinds of things. And that's the way we're going to get employment and all the benefits back up on that. It's not going to be preserving lower paid service jobs or manufacturing jobs. It's going to be education and employment in those growing areas. So that's where I would bet on.
I mean, you mentioned that one of the key aspects of due diligence, in your work is strategic alignment with the senior leadership team and kind of how important that is. And I'm particularly interested in that, the DeMoore McKim alumnus and board trustee member is Ted English, who's the CEO of Bob's Discount Furniture, which just took a big stake in. And so I wonder if you could say more generally about how you go about searching for that alignment, because I think some of the students would probably know a lot about what goes on in kind of financial modeling sort of due diligence, but how do you suss out the team?
Well, that's a great question. In fact, what's today, Saturday, I'm having dinner with a chief executive of a company that we're thinking about putting investment in, and and his wife is coming in, and our team's going to meet them, and we're going to spend time with them tomorrow. And the whole issue is, are we aligned about the same vision for the business, the growth rates we think can be achieved, the strategies that we'd want to do, the globalization of the business, and we want to get just as comfortable as he wants to get to say, okay, are we on the same page on that versus other alternatives that he might have or we might have to invest into. So I think the best investments are ones where you go in and have a management team and have a whole company culture, buy off on the same set of goals and strategies and the same ways of operating. And if you don't have that, you're going to have real problems. So we spend an awful lot of time not only looking at the opportunity as the opportunity itself, but does the company have the culture, a management team that kind of agrees that we want to get up and build new products and take share and share that same kind of strategic vision that we'd have as Bain Capital. So in every investment we do, we actually evaluate, do due diligence and evaluate it, but at the same time we're building a strategic plan of something we think is the full potential of the company and what it can achieve. So an example of this would be we bought a company called Daytech about 15 or 20 years ago. It was the leading system for kind of doing trading over the internet. When back 30 years ago, the only way you could buy a stock was to pay a stockbroker $60 a share. Companies like Daytech came out and Ameritrade, and they were helping people transact at $9.99 a share. And we saw that as a high growth industry. Daytech had some issues. The founder had some issues with the government, so we looked at it. They brought a new management team in. We loved the new management team. We thought it would have a big growth area, but we sat down with the management team and said, ultimately, right now, at that point in time, we had 5 or 6 companies, E-Trade, Schwab, Daytech, Ameritrade, TD Waterhouse, all going for the same market. And we felt like Daytech had the best system to do that and the lowest cost system to execute trades for customers. And we felt that there'd have to be a merger plan where we would either buy some people or we'd merge with those people. And the management agreed, with us. And so, and you have to have that because obviously if we went into a merger with a bigger company and the management was fighting that, it wouldn't happen. So we actually went out and talked to each of the CEOs of those other companies And over a period of 5 years, we were able to merge Daytech with Ameritrade, and then Ameritrade merged with TD Waterhouse. So this, from the seeds of Daytech and Ameritrade, what's been created is the largest online trading company in the world is Ameritrade today. And that was really because we were aligned with management. We had a similar goal, similar vision, that for that company to grow and prosper, it had to do acquisitions or be acquired by another company. So that's really how we do it, and I think it's a very critical thing, you know, as in the day-to-day of looking at investment.
Thank you very much.
Thank you.